It's one of the absolute most consequential yet completely hidden financial mechanisms in the world today. We're going to be unpacking exactly how a high-speed, digital trade executed on Wall Street can literally dictate the cost of the physical food sitting on your local grocery shelves thousands of miles away.
To kick things up, we really need to bridge the gap between two realities that might seem totally disconnected at first glance. I mean, we all know how massive institutions like Goldman Sachs or huge commodity hedge funds generate their immense revenue, right? But the source material we are diving into today argues something pretty intense. When these massive funds profit during a global crisis, that windfall is intrinsically linked to someone, somewhere in the world, having to pay a serious premium for their daily bread.
So we'll unpack this whole chain reaction in 5 quick steps. The agricultural boom, how futures dictate prices, the 2008 historical precedent, the humanitarian cost, and finally, market utility versus regulation.
All right, starting right off with Section 1, the agricultural boom.
Okay, so following the recent Hormuz closure, we saw speculators aggressively piling into long positions on some absolutely crucial agricultural futures. We're talking staples here: wheat, corn, rice, soybeans, sugar, and palm oil. Basically, they're anticipating physical supply disruptions and front-running the market, driving prices upward way before any actual shortages even materialize.
And when we talk about who's actually driving this speculation, our focus really lands on what's called managed money. We're talking hedge funds, commodity trading advisors, and high-speed algorithmic systems. Listen, these guys aren't buying wheat because they want to bake bread. They're buying the contracts to capitalize on the sheer, unpredictable volatility of global crises.
Moving right along to Section 2, how futures dictate prices.
Now, the source frames this dynamic with an absolutely brilliant analogy: the speculative tail wagging the physical dog. See, in a normal, typical environment, physical supply and demand dictates the financial price. But in these highly speculative markets, the whole dynamic just inverts. Financial positioning actually forces food prices way above the levels justified by what's actually sitting in silo inventories.
So the chain reaction works a bit like this. First, managed money buys up massive quantities of long futures contracts. This sudden, huge capital influx forces futures prices to just surge on the exchange. And because those futures set the benchmark for actual physical delivery, real-world players, like your grain elevators, processors, importers, they are instantly forced to adjust their physical bids upward. The speculative benchmark literally becomes the real-world price.
Which brings us to Section 3, the 2008 historical precedent.
20 to 40%. Just let that sink in for a second. During the 2008 crisis, yeah, the physical supply disruptions were definitely real. But according to a 2011 UN investigation, financial speculation amplified those price moves by 20 to 40% above fundamental reality. That is a staggering premium added entirely by financial market behavior.
And this historical precedent? It's exactly why the current landscape is setting off massive alarm bells right now. The source notes that today, in 2026, speculative flows into agricultural futures have hit multi-year highs. This elevated volatility is, of course, incredibly profitable for traders, but it's replicating the exact same conditions that artificially spiked global food prices almost 2 decades ago.
Let's shift gears to Section 4, the humanitarian cost. 783 million. That is the jaw-dropping number of people globally who are already facing chronic hunger and severe food insecurity. Look, when the price of basic, everyday staples like wheat and rice is artificially inflated by 20 or 30% due to market speculation, it's not just a minor inconvenience at the checkout line. For these populations, it is literally the difference between eating and starving. They are the ones effectively paying that premium between the fundamental price of the food and the speculated price.
Now, while some folks defend these market moves as just standard operating procedure, critics in our source material push back hard. They actually call it, quote, a moral obscenity dressed up as market efficiency. And you have to admit, it raises a highly uncomfortable question. At what point does capitalizing on a looming food shortage cross the line from smart investment to outright exploitation?
And that brings us to our final part, Section 5, market utility versus regulation.
It's a really tricky balancing act, right? Futures markets aren't inherently malicious. They are absolutely vital for things like price discovery, and they allow farmers to hedge the risks against ruined crops. But stacked against that utility is an undeniable humanitarian risk. When speculation runs unchecked, the resulting artificial inflation creates a massive premium paid directly by the Earth's most vulnerable people.
So, as we wrap up this explainer, this brings us to the ultimate regulatory question currently dominating commodity markets. When a crisis hits, should lawmakers actually intervene? The primary legislative solution being debated right now is the strict enforcement of position limits during recognized food crises. Proponents argue that regulators, like the CFTC, must have emergency authority to legally cap the number of agricultural contracts any single algorithmic trader or hedge fund can hold, basically short-circuiting their ability to corner a market and artificially drive up prices. But on the flip side, opponents counter that such heavy-handed legislation strips liquidity from the market exactly when it's needed most, completely breaking the mechanism of price discovery. It's a fierce legislative battle between preserving absolute market freedom and building a regulatory firewall around the global food supply. So where do we draw the line between a free market and a protected one? Think about it, let me know your thoughts, and I'll see you in the next explainer.